Well, taking a look at what has happened on the Asian side, we saw markets on that front trading mixed. Of course, the big eye is on those U.S. jobs report numbers. They're important because they give us a key indicator of what we can expect from the Fed. When you look at the individual bourses, starting with the Nikkei, that closed in positive territory. However, when you look at what was going on the Hang Seng side of things, that seeming to lose some of its gains, it closed flat for the day. The same kind of negativity played out on the Chinese front when you look at the Chinese main land markets. When you start to look at the Shanghai Composite down 0.6%, the Shenzhen component down 1.9%. However, when we move further afield to the European markets, those markets trading a bit cautiously. Of course, they are looking at those U.S. jobs report numbers that we are expecting a little bit later on. But at the same time, there seems to be this idea around global markets where a little bit of optimism is kicking in as we're starting to see a surge in commodity prices, as well as the fact that investors are digesting those corporate earnings that have been coming through for the course of the week on the European side. As we shift focus to the U.S. futures, those markets are rising. Of course, the big news on that front is going to be those jobs reports numbers. Lots to talk about, lots to unpack, and we're going to be doing that with Warwick Lucas from Galileo Capital. Warwick, thank you so much for your time.
Only a pleasure, Tash.
So, let's start to look at what is happening on the JSE currently, taking into consideration, the picture that I've just painted right now, what's happening on the local markets.
All right, in terms of the JSE and South African data, we generally had a sideways to slightly better kind of week. Certainly our bond markets are going better. The rand has been a tad firmer, and the likes of gold and platinum have been looking quite good, and all of that's added up to a market that's just a little bit better, because our local market doesn't like a really, really strong rand, but our bond market does. And so that's it in a nutshell.
So when you look back at the trading week that was, it's not quite over yet. We haven't reached 5 p.m. But so far, how would you characterize it?
All right, so I think quite a lot of the global market reflected a similar kind of story. I think in the US we saw it looking a little bit timorous with Biden's tax or proposed capital gains tax capping the market off, but not doing too much damage. I think some anticipation there that this process is going to go through Congress and there'll be back and forth, and eventually it'll settle down at a figure that shouldn't shake people up too much. In terms of the EU, we saw them go into a double-dip recession, but perhaps also more concerning is their relations starting to get a little bit worse with China. So we hope that kind of process there flattens out and finds its footing.
Earlier this week, we had comments from Janet Yellen that managed to rattle markets, although she did a little bit later on clarify her statements. Yet something that is most likely to probably rattle markets a little bit more is the semi-annual financial stability report that was released yesterday. And it, raising the concern that rising asset prices are, posing as an increasing threat to financial stability. What did you make of that?
Well, I think a lot of it is what we often inelegantly refer to in our corporate lives as covering your butt. It reminds me very much of Alan Greenspan in 1997, commenting on an excessive degree of irrational exuberance in markets when the Fed thought that the market was a little bit on the high side. And I remember at the time, the market promptly proceeded for the next 2 years to continue to go higher and higher. And that, of course, highlights just how hard timing markets can be when a massively informed individual like that, or entity, where if we refer to the Fed, struggles even with the information it has to call a top in markets. But I think what it does highlight is first of all, they're saying, well, things are quite hot, but lots and lots could happen. So, for example, we've seen lots of fiscal stimulus. We've seen lots of monetary stimulus. But by the same token, a lot of individuals in the US have been saving quite extensively. And that means that, so while government has been piling the amount of cash available into the markets, individuals have been going in the other direction, which means that there's a lot of offsetting that's been going on. So the whole sort of inflation picture gets to be quite complicated.
So we are expecting the U.S. jobs report numbers later on. From your expectations, I mean, what are you looking for? Are you thinking it could be a key indicator of whether the Fed could start announcing some kind of tapering later this year when it comes to asset purchases, or perhaps an indicator in where bond yields could move?
Okay, so the jobs data is always a tricky one. I think the first thing that to remember about it is that it's not exactly measured. It's sampled. So there's quite a lot of noise that goes into that data. That is expected to indicate jobs growth of around about 1 million, which is quite a nice number up, and to possibly push the formal unemployment rate better than 6%. But it's important to remember that the definition of unemployment is a bit messy. And one of the holes in it is that it cuts out people who have effectively given up looking for work. Now, on the other side, there's a much less quoted data item, which is long-term unemployment, which is people who've been unemployed for over 27 weeks or 6 months in the US. And that figure is actually quite well up on historical figures. So, I mean, a long-term historical figure in the last 3 or 4 years was below 1%. That's now up at 2.5%. So that still indicates that there's a bit of slack there for the Fed to work with. And quite frankly, given that the Fed has moved from trying to forecast where things are going to go to simply saying that, right, here's an outcome and we'll work with this outcome as it stands.
Yeah.
I think the Fed is going to basically say, right, we'll stand pat for now. And I think they will do it in a manner that probably keeps on pushing inflation for a bit.
Warwick, let's leave it there. Thank you so much for your time. That is Warwick Lucas from Galileo Capital. Later on, we are expecting an announcement from Moody's where they will be giving us a review of South Africa's credit rating. Of course, we'll always keep you posted on that front.